The Kenyan government spends more than it earns, meaning that revenues collected through taxes and other means can only go so far to cover the expenses. The government then has to borrow locally and internationally to cover the gap. As part of its domestic borrowing, the government sells treasury bonds and treasury bills to banks, pension funds, and insurance companies. It also sells them to the general public. Kenya's total public debt is approximately 11.36 trillion Kenya shillings, with a portion of that debt held in the form of treasury bills and treasury bonds issued to Kenyans who lend to the government. So, here's the trillion shilling question. Should you invest in treasury bills and treasury bonds? But before we get ahead of ourselves, what are treasury bills and treasury bonds?
For treasury bills, they issue in tenors of 3 months, 6 months, and 1 year. So that's where the cash element comes in, because it's short term. Anything that with a short-term investment horizon is deemed as cash or near cash, whereas anything above 1 year is now where the different assets comes in. Treasury bonds is like you're bonded for the period of your investment. So for instance, if you buy a 2-year treasury bond, it means that for the next 2 years, you've given Government of Kenya your money, whatever it is. Minimum investment is 50,000, and then it's a bond with the Government of Kenya. So the commitment by the Government of Kenya is every 6 months they will be paying you back what you call a coupon payment up until the end of the 2 years, and then you get back your investment.
Deciding between the two investment options will depend on several factors. First, your investment horizon, which refers to the length of time you intend to hold an investment before requiring it. This implies treasury bills for the short-term horizon and treasury bonds for the long-term horizon. 2. Tax breaks.
What you have seen being favorite is now what you call infrastructure bonds. This is a segment of treasury bonds. On the coupon that you receive from the government, there is no withholding tax that the government withholds. So that has really attracted the masses, be it retail investors, be it local institutions, because of that tax-free element.
The third factor is the coupon rate, also referred to as the interest rate. Due to their long-term nature, treasury bonds have a higher coupon rate compared to treasury bills. The fourth factor is liquidity. Both T-bills and T-bonds have high liquidity. However, T-bills offer lower yields and do not provide periodic interest payments. Whether T-bills and T-bonds interest rates are favorable depends on an investor's financial goals, risk tolerance, and broader economic context. However, interest rates are influenced by demand and supply, the microeconomic environment, and the central bank rate, which acts as the benchmark for all lending rates.
So for instance, most investors, as they participate in the auctions, be it treasury bills and treasury bonds, the kind of return that they will want is the return at least will ensure that they are compensated adequately for future inflation risk that might crop up. If you look at where inflation was a year ago in January, it was around 9%. So from investors' perspective, they were also sort of pricing in that inflation will remain 9%, and a result of that, they will want now to be adequately compensated by that higher inflation. But you've seen gradually that central bank rate has been reduced. Right now is at 10%. Because of the benchmark rate trending lower, that has also affected expectations by even the market participants as they go to demand the extra yield from the government.
Given that the government is constantly in debt, how secure are your investments in T-bills and T-bonds?
That's the good thing, that we are perpetually in debt. And it's not a peculiar situation in Kenya, just to put it out there. There's just a few countries run what you call a balanced budget, whereby their revenues that they get from taxes and non-tax revenue is able now to fully finance the spending plan. If you look at the SGR project, yes, we borrowed in dollars, but the revenues from SGR is in Kenya shillings. So the thing is, how do we service this currency mismatch? How do we increase our exports to be strong enough, to be high enough to be able to service this debt without creating some pressure. So those are the mechanisms that the government needs to ensure are in place to reduce the debt vulnerabilities.
As the government continues to borrow, institutions and private citizens will continue to invest. With a minimum investment of 50,000 Kenya shillings, you can transform that perpetual debt into your personal wealth.